Well, let's invite our next guest. We have Neil Bahal, founder and CEO at Negen Capital PMS, who joins us. Hi, Neil. Thanks so much for joining in. Good speaking to you. First time I think we're having you on the show. If you could tell us, I was looking at a couple of updates that you put out there, and in the last 3 years or so, it appears that returns have been pretty good for your, all your clientele. Has there been a bit of a slowdown now, or is there enough enthusiasm at around 17,000 on the Nifty, if you compare it with what it was in the early teens?
Hi, Nigel. Thank you for having me. Yeah, you're right. This is the first time I'm on CNBC. So it's a pleasure to be here. So, in terms of slowdown, I don't see any slowdown. The way things are going, I think India is very well placed. And what we are doing is, anyways, we don't have a view on the stock market. We typically look at companies and we try to buy them at discount valuation. We are a special situations fund. So for us, looking at the market doesn't make any sense.
Okay, fair enough. Neil, hi, good afternoon. That actually works for us because, that means, you can talk about some stock ideas. I'm looking at your PMS. Piramal Enterprises stands out. How have you looked at the listing post that demerger? Because a lot of people thought that maybe the fair value was around 1,200, 1,300, but the stock's been struggling a bit.
So it's very interesting. Special situations work very differently in the short term, and the value creation happens in the long term. So, think about it. Generally, the people who bought Piramal before the demerger, the idea was that, the pharma business is the desirable business and the NBFC is a good business, but the pharma is a better business. So what happens typically post a demerger is the people who got one share of NBFC and one share of the pharma, the way people work is the behavioral finance is such that people would want to hold the pharma and people would want to sell the NBFC. So I agree with you, the fair value should be much higher, but this is a period of adjustment where the people who don't want to own the NBFC would be trying to sell out of it. So you're pretty cool. Before the demerger, when it was trading at 1,600, it was almost as if, the holding company discount is going to go away. And that has gone away. And now in the NBFC, the value discovery process is going on.
Neil, what about this QSR theme? I see Sapphire Foods as part of your top holdings as well. The street is pretty excited about that. There seems to be a valuation mismatch, so to call it as well, between Devyani and Sapphire. Give us some more rationale about holding Sapphire in your portfolio.
So, first of all, we own all of these stocks, and they're not investment advice. We're just discussing the overall rationale. So, QSR has completely changed. I can tell you one thing: how you begin to work on the QSR space. Think about it this way: India is going to sell more burgers every year for the next 25 years. Okay, so the runway is huge. Now, when you look at the sector and look inside, you want to look at companies which have a very high return on capital on a store level. So when we did the analysis, KFC stood out much ahead of something like a McDonald's. It stood out much ahead of something like a Burger King. And when you do further analysis, KFC and Pizza Hut have two different franchises. One is Devyani and one is Sapphire. Now, the only thing why we wanted Sapphire in the portfolio more than Devyani is because Sapphire valuation-wise is much cheaper. I think there were some issues with Sri Lankan operations. That's why the stock price was not performing as per expectations. But I think now that that situation normalizes over time, I think the valuation gap between Sapphire and Devyani should narrow going forward. That you're absolutely right, Nigel. The gap is too big to sustain, and that is what we are thinking in our PMS. Is that while the earnings growth will be very strong in both Devyani and Sapphire going forward, but the valuation gap in Sapphire means Sapphire stock going forward, at least the hope from our end is that the valuation re-rating should also keep happening on Sapphire.
Actually, it looks like you really like this space. In the unlisted space, I think you're Burger Singh as well. that name is very interesting. I just Googled it and,
Even I did that.
Yes.
Yeah, so we are very bullish on the QSR space. And I'll give you an example. In 2004, two companies did an IPO. One was Google and the other was Domino's. And while the world has celebrated Google as one of the best companies in the world, and in fact it is true, the stock which has done better than Google at the same IPO time has been Domino's. The Domino's stock has returned a 7,000% return versus a 4,800% return for Google. So what the US was in the QSR space about 20-25 years ago. I think India is not even reached that base yet. So the growth potential in India is tremendous. And because of this pandemic, the delivery portion of overall revenue has gone up for QSR, and that has improved unit economics amazingly. So earlier we had a very good runway, but the unit economics were not so good. But suddenly today, what you have is, while the runway continues to be good, as I said, India will sell more burgers every year for the next 25 years. I'm pretty certain of that. But at the same time, the unit economics will keep improving. So I think it's a one unbelievable opportunity. India provides great opportunities across the board, but I think QSR is one of those ideas which have to be top of the line for me.
Okay, all right. What about, in this sort of a market, you need to be careful with the broader market themes. But as you're saying is, you're not really worried about the headline index. You're looking at bottoms-up stock picking. And I'm looking at a couple of companies in there. Tips Industries, a couple of other names, Coastal Corporation as well. Since you're talking stock specific with, your disclosures as well, could you tell us what's the rationale on both these two?
I think these are the smaller companies, so let me not talk about them more in detail. I'll tell you about the sector in Tips Industries, for example. About 20 years ago, Tips and Saregama, these two kind of companies, you would think that, they were having a very tough time running the business, or no one pays for buying music. But recently, again, the rise of the internet in India and the rise in the internet globally has completely changed the business model for these guys. They are no longer trying to sell their music. All they have done is just uploaded their music on YouTube. And every year, YouTube itself grows. And because of that, they have natural tailwinds. And the beauty of the business is that these are the tech companies which are highly profitable. The return on capital is at 80%, 100%. So they are cash cows, basically. They're churning out so much cash every year. And it's a kind of the music catalog they have, that there's no competition. There can't be a situation where tomorrow a private equity backed player comes and says, I'll burn money. They can't, because the songs that they own for the next 60, 80 years. So it's an absolutely beautiful business model backed by the fact that the internet itself is expected to grow over many-fold over the next few years. So we love these kind of businesses.
Okay, yes. Tips for 90s used to dominate the music industry along with T-Series. So that's on music. What's interesting is, looking at some more names. In the NBFC space also, you've taken a couple of bets, Chola and Ujjivan.
Yeah. So, both of them are from different perspectives. Ujjivan, you know that not a lot of people have made money, but we looked at it from a special situation standpoint. So what we did is, first we had a view on the entire sector. So we went and we did scuttlebutt. We spoke to all the players who are unlisted, and we got one simple idea from everyone, is that the microfinance industry has kind of bottomed out. This happened a few months ago. And when we got that basic view on the sector, we started looking at the sector opportunities. And as you know, we want to do something where we have a margin of safety in terms of special situations. So Ujjivan had a situation which was very amazing, where the holding company is there and an operating company is there, which is a small finance bank. Now the holding company is set to reverse merge with the operating company. And when that happens, you have at the time, at least when we bought, there was a lot of margin of safety. There was a 40% arbitrage, basically. Then for us to be wrong on Ujjivan, we had to be wrong by more than 40%. So while we had a good view on the sector, we had that margin of safety in terms of this reverse merger. So Ujjivan is kind of like a cigar butt opportunity, where we don't have a view beyond 2 years and 3 years. But Chola, on the other hand, is an amazing story, and I feel it's a transformation story. Being a normal NBFC, the Murugapas have been able to kind of grow the business at a 30% CAGR for the last 10 years. And now they're going from being a normal vehicle finance kind of a player into a fintech. Now, when that kind of transformation happens into a business, the valuations will also re-rate. So again, whatever we do, we look at from the point of view from earnings growth on the one hand and valuation re-rating on the other hand. Whenever you have this valuation re-rating working for you in your portfolio, you can create alpha. So the view for that we had on on Chola, was that on the one hand, the earnings should grow 20%, 22% for the next few years. And on the other hand, the valuation will start re-rating as a fintech. It should start getting better and better valuation every year.
All right, Neil, good speaking to you. Thanks so much for stopping by. As you said, you're bottoms up, you're looking at stock specific. You refer to yourself as maybe going for a bank auction and trying to buy assets that are below the value that you believe. Good speaking to you. Thanks so much for joining in and giving us your inputs on a few of the stocks that we did discuss.